Welcome, directors, executives, and all of you focused learners out there to this explainer. Right now, we are analyzing a really sudden systemic market shift in digital assets. And look, if you happen to manage a corporate treasury, maybe you oversee venture allocations, or honestly, if you're just monitoring broader macro liquidity trends, you absolutely need to be paying close attention to this. Because frankly, this is not your standard weekend retail panic. Historically, some executives kind of viewed crypto as this isolated sandbox, right? Something totally detached from traditional equities. But today digital assets act as a highly sensitive canary in the coal mine for broader macro risk. What we're seeing right now is a highly coordinated structural liquidity crisis hitting Bitcoin. And understanding the specific mechanics behind this rapid outflow is, well, it's an absolute strategic necessity. Why? Because the exact forces draining capital here are the very same macroeconomic forces that are inevitably going to influence traditional markets next.
Okay, let's dive into this, and I want you to immediately consider the sheer scale of the number we're looking at here. $3.45 billion. That is the exact amount of institutional capital that has literally evaporated from exchange-traded funds in just a matter of days. For any executive out there modeling market risk or stress testing a portfolio, this number, it's a massive red flag. I mean, it proves definitively that this current sell-off is not retail-driven. No, it is institutionally driven. The smart money is moving. They're moving incredibly fast, and they are taking their vital liquidity right out the door with them. When billions exit a highly regulated traditional financial vehicle like a spot ETF in under 2 weeks, it signals a fundamental reassessment of risk parity across the board. You have to remember, these funds were supposed to be the sticky capital, the capital that permanently stabilized the asset class. But instead, their rapid evaporation demonstrates just how quickly institutional allocators will completely abandon a position the second broader macroeconomic indicators start flashing red.
So to really grasp the strategic impact of this drawdown, we've structured this explainer as a clear, boardroom-ready roadmap. We're going to track 5 specific data-backed macroeconomic and institutional drivers behind this crash. We've got number 1, the ETF Exodus. Number 2, corporate signals. Number 3, the Mt. Gox overhang. Number 4, the AI capital rotation. And finally, number 5, whale liquidation.
All right, let's jump right into driver number 1, the ETF Exodus, which really marks a sudden institutional exit from the space.
So for the past year, institutional adoption was basically the prevailing bullish thesis for digital assets, right? But based on these latest capital flows, I can safely tell you the institutional honeymoon phase is officially over. Leading into late May, U.S. spot Bitcoin ETFs didn't just have a couple of choppy days. They recorded massive, sustained withdrawals across 11 consecutive trading sessions. Just think about that. 11 straight days of institutional capital fleeing the market. In corporate finance, a continuous hemorrhage like that isn't just a blip or a statistical anomaly. It represents a decisive strategic reversal in institutional sentiment. Imagine for a second if a major sector in traditional tech equities, say cloud computing or semiconductors, saw 11 consecutive days of relentless capital flight from its primary index funds. It would trigger emergency board meetings across all of Wall Street. It clearly indicates that the fundamental algorithms and the institutional risk models managing these massive asset pools have uniformly triggered sell signals, rapidly moving capital out of high beta risk assets into safer harbors. The strategic impact here is profound, and frankly, confidence is entirely shaken. This was the largest monthly ETF exodus of 2026, and it brings us directly to our first major operational risk: collapsed buying pressure. Look, when you completely remove the foundational liquidity that provides daily price support, the floor inevitably falls out from under the asset. In any market, but especially in one as historically volatile as digital assets, price stability relies on a constant bid. You need a reliable stream of incoming capital ready to absorb routine selling. The ETFs were providing that exact foundational bid. But with that bid now wiped out, corporate balance sheets exposed to this asset are suddenly incredibly vulnerable. We are left with a fragile market structure where even relatively minor sell orders can cause disproportionately massive drops in valuation simply because, well, there's no institutional net left to catch the falling knife. Moving right along to driver number 2, corporate signals and the resulting psychological shock that follows.
Now, what's really interesting about this slide is the sheer disproportion of the action versus the market's reaction. MicroStrategy, which is famously the largest corporate holder of Bitcoin, filed a report showing they sold just 32 BTC. Honestly, in the grand scheme of their massive multi-billion-dollar corporate treasury, this dollar amount is virtually microscopic. It's literally a rounding error. However, this marked their first net reduction in holdings in 3.5 years. And the mechanics of the resulting panic are just fascinating from a behavioral finance perspective. See, retail investors constantly look to mega holders for conviction. The optics of the ultimate long-term corporate holder finally taking even nominal profits, it triggered absolute panic and a massive wave of retail profit-taking. Retail traders didn't sit there and calculate the tiny percentage sold, they only saw the headline that the biggest bull in the room had finally hit the sell button. It's a textbook lesson for any executive in how incredibly sensitive market sentiment actually is, and how a tiny, totally routine corporate rebalancing can inadvertently spark a market-wide firestorm.
Which brings us to driver number 3, the Mt. Gox overhang, introducing some truly massive legacy risk.
This is such a fascinating variable because it's essentially a ghost from the past waking up to heavily disrupt today's market environment. The defunct Japanese exchange, Mt. Gox, which has held the keys to billions in locked funds for a decade, suddenly woke up. They moved $730 million worth of Bitcoin from their cold wallets, and this represents their first major on-chain move in months. To really understand why this is a blaring siren for institutional risk managers, we have to talk about the difference between a cold wallet and an active exchange. A cold wallet is offline, it's secure, and it's entirely dormant. Assets sitting there are mathematically removed from circulating supply. But when $730 million gets transferred out of that deep storage, it signals imminent distribution. For an executive tracking supply-side metrics, this isn't just a random number on a ledger. It's a massive, impending supply shock preparing to hit an already weakened ecosystem.
And what this creates is a highly destructive phenomenon, presenting our second major operational risk, liquidation anxiety. It's the market panic sparked by fears that early investors and creditors of a defunct exchange will immediately liquidate their recovered funds. The absolutely crucial distinction to make here is between over-the-counter or OTC selling versus open market dumping. If these funds were sold OTC in private, negotiated blocks between large institutions, the broader market price wouldn't really be deeply affected. But the intense fear right now is that thousands of retail creditors, people who have waited 10 years and are sitting on massive percentage gains, well, they won't use OTC desks. The fear is they will simply dump their coins directly on a public retail exchanges. This specific fear acts as a massive, heavy anchor on current market support. Institutional capital completely freezes in this scenario. I mean, absolutely no one wants to deploy fresh capital and step in as a buyer when they know a tidal wave of early-era coins is actively looming, ready to drastically dilute the market and cause immediate punishing price slippage. All right, driver number 4, the AI capital rotation, which is causing a severe liquidity drain across the board. Now, this isn't just about crypto-specific events anymore. It's about crushing macro pressures and a broader, undeniable industry trend. The broader strategic shift is laid out right here. Historically, Bitcoin traded sympathetically, acting very much like a high-growth traditional tech stock. But right now, we are seeing a severe and growing disconnect. Traditional tech equities are experiencing massive capital inflows, essentially booming because of the artificial intelligence sector. Meanwhile, digital assets are quite literally being starved of fresh liquidity. Massive amounts of capital are actively rotating out of the crypto market and vacuuming directly into AI infrastructure. We are watching a generational pivot play out in real time, where venture capital firms and forward-thinking corporate treasuries are actively abandoning the Web3 thesis they championed just a year ago and aggressively reallocating those exact funds into generative AI startups and data center real estate. If you are a director allocating capital today, the industry trend is glaringly obvious. AI is currently the dominant narrative, and it is systematically siphoning away the institutional liquidity that previously would have padded and protected digital assets during a downturn. And finally, driver number 5. Whale liquidation, culminating in what I can only call a systematic shock. Look, the market might have survived one or two of those aforementioned macro pressures, but massive on-chain offloading by the absolute largest holders definitively broke the structural support lines. And this brilliantly illustrates the staggering difference in scale we're dealing with here. On one side, we have a psychological shock, MicroStrategy selling a mere 32 BTC. As we discussed, that alone was enough to spook retail. But on the other side, we have a true systemic shock. On-chain analytics revealed that Bitcoin whales, and just to be clear, these are massive entities holding over 10,000 BTC apiece, dumped roughly 24,000 coins in a single week. 24,000 BTC offloaded in just days. Under normal, bullish macroeconomic conditions, the market might actually possess the depth to absorb a 24,000 coin distribution over a few weeks without catastrophically breaking the trend. But in our current, severely starved liquidity environment, where ETFs are bleeding out and AI is stealing all the available capital,
This kind of coordinated dumping is just a devastating reality for the market to absorb. It overwhelms the order books entirely. The market mechanics resulting from this mass offloading present our third major operational risk, a total liquidity vacuum. This severe dumping caused an immediate contraction in spot markets, sure, but far more dangerously, it contracted the perpetual futures markets. Now, for any directors unfamiliar with crypto market architecture, perpetual futures are highly leveraged derivative contracts. When spot prices are driven violently below key support levels by massive whale selling, it triggers a cascading series of forced margin calls in the futures market. Long positions are automatically liquidated by the exchanges, which then forces the engines to market sell even more Bitcoin, driving the price down further, which then triggers the exact next level of liquidations. It is a vicious, automated downward spiral. And you want to know the most dangerous element of this entire scenario? Zero retail or institutional buyers stepped in to catch the fall. The total liquidity vacuum meant that the sheer weight of these whale sales went completely unchecked, crushing demand across the board and fundamentally resetting the entire asset class's valuation floor. So for any executive or director analyzing this space right now, here is the architecture of the perfect bearish storm. Notice how every single step fundamentally triggered or worsened the next. Step 1, the ETF Exodus stripped away that foundational institutional support, leaving the market highly sensitive. Step 2, MicroStrategy, taking nominal profits, exploited that sensitivity, shattering retail psychology and triggering the initial panic. Step 3, MT Gox waking up introduced a massive legacy liquidation overhang, essentially freezing anyone who might have otherwise stepped in to buy the dip. Step 4, AI actively stole the broader market's fresh liquidity, ensuring absolutely no rescue capital was waiting on the sidelines. And finally, Step 5, the whales recognized all of this compounding weakness and aggressively dumped 24,000 coins, completely crushing whatever fragile demand was left. These 5 factors did not happen in isolation, folks. They linked together perfectly to create a severe, coordinated systemic squeeze. I want to conclude this explainer by leaving you, the directors, the executives, the risk managers, with this final provocative strategic question to really ponder regarding the future of your own corporate treasuries. Is this contraction merely a temporary market correction, or are we witnessing a permanent reallocation of risk capital away from digital assets? The macro data and the institutional flow metrics, well, they're clearly laid out on the table for us. But how you choose to position your portfolio in response, that is the real challenge. Remember, as a risk manager, your ultimate duty isn't just to capture yield. It is the absolute preservation of capital in the face of structural market shifts. Thank you so much for joining me for this explainer, and I highly, highly recommend reviewing these compounding structural risk factors with your own internal strategy teams.